Here's the clean rule. Income received before death goes on the decedent's final Form 1040. Income received after death belongs to the estate and is reported on Form 1041. On the EA exam, they'll test timing, not what the money relates to, but who received it and when. Interest, rents, dividends, and sale proceeds after death usually push you into 1041 territory. Form 1041 is an annual income tax return for the estate during administration. The estate is its own taxpayer from date of death until it terminates. If the estate earns income, like rent, while a house is held in probate, that's 1041 income. And if income is distributed or required to be distributed, the estate issues Schedule K-1s to beneficiaries. Exam tip: don't confuse 1041 income tax with 706 estate tax. Now the filing triggers. A domestic estate must file Form 1041 if it has at least $600 of gross income for the tax year. Also, it must file if it has a non-resident alien beneficiary, even if income is tiny. That second trigger is a favorite exam trick. They'll give you $50 of bank interest and an NRA beneficiary and ask if a return is required. It is. Estates can choose a calendar year or a fiscal year. That choice is made on the first Form 1041, and it can help with timing income to beneficiaries. The due date is the 15th day of the 4th month after the tax year ends. For a calendar year estate, that's April 15th. Need more time? File Form 7004 for a 5.5-month extension, often landing on September 30th for calendar year estates. So, when does the estate end? Generally, when all assets and income are distributed and all liabilities are paid. That's the termination year. Here's why it matters. Only in the termination year can certain unused deductions and losses pass out to beneficiaries. In a non-termination year, losses stay trapped at the estate level. On the EA exam, watch for language like final year or estate closed. That's your cue. One more high-test area: income in respect of a decedent, or IRD. This is income the decedent earned before death but didn't receive before death, like cash method receivables. IRD does not go on the final 1040 just because it was earned earlier. It's taxed to whoever actually receives it after death, either the estate on 1041 or the beneficiary on their 1040 if it's paid or distributed to them. Mateo has a loss from worthless securities. How many years does he have to amend his tax returns in order to take this loss? The options include 2 years, 7 years, 6 years, or 3 years. Think about it. This is one of those statute of limitations exceptions. The correct answer is 7 years. Refund claims tied to a worthless securities loss get a special 7-year period, not the usual 3-year rule. The tempting wrong answer is 3 years, because that's the general refund claim statute, but worthless securities is a specific exception the EA exam expects you to know. Before her death on January 1st, Natalie ran a custom bridal dressmaking shop using the cash method. A vendor owed her $20,000 for a dress. The vendor paid on March 1st, after Natalie died, and made the check to the estate. The estate didn't distribute the $20,000 to her son, Ethan, before the estate was settled. Where is the $20,000 reported for tax purposes? Think about it. The correct answer is the estate's income tax return, Form 1041. This is IRD, earned before death, received after death, so it's taxed to whoever receives it. The estate received the check and kept it during administration, so it reports the income. The tempting wrong answer is Natalie's final 1040, but IRD is not reported on the decedent's final return.